good evening to all our guests right here at the Geylang Serai Virtual CC. Yes, welcome down. And of course, for friends who are tuning in, we'd like to wish you a very happy Tuesday night itself, okay? So my name is Hui and welcome down to the next series of the Money Mastery program. And right here for today, we are actually showcasing to you in terms of unit trust and how you can build a portfolio using some of the techniques brought to you by our guests right here. So what we have right here for today, this program actually aims to educate the public and on the business and finance as to prepare our citizens to be future ready while Singapore marches towards its mission to be Asia's business and financial hub. So to better outreach to the masses, it will be a series of a dialogue program, and of course it will be aimed to have a twist of the informal, interactive and infotainment program covering local and international business and financial news. As you can see that we are all masked up, okay, we are kind of like getting ready and getting, convenient and of course getting adaptable to this kind of environment. Of course, for friends who are right at home, do stay safe, and of course right here do continue to interact with us. And at the same time, if you have any queries pertaining to your financial goals and all that, feel free to reach out to us anytime as well, okay? And right now, let's kickstart with the proper of the program for today. Let's pan our screen to the slides. So a quick disclaimer before we kickstart the program itself. This program is actually for information purpose only and should not be constructed as recommendation for purchase, sales, subscribe, or participate in any services or products. Before acting on the information provided, please consider if it suits your objective and risk tolerance. Should you need professional advice, do consult the MAS Registered of Representative list. If you need more assistance, you can refer to the qualified professional for your consideration, and that's something that we can do to refer to you as well. So right here for today, yes, we actually have this topic which is called the unit trust. I believe that most of the friends are actually quite familiar with unit trust. But how to actually build unit trust towards a portfolio of investment as a form of asset allocation today itself is actually the main topic on us, how to actually build up a portfolio to hit our retirement goal. So with that for today, joining me right here in the studio, I actually have Mr. Raymond Wong. He is actually featured on the TV, Money Week, Hello Singapore, Frontline, the Straits Times, seminars, and various organizations. And of course, right now, he's actually also an associate director in one of the top advisory group in the largest and oldest independent-owned advisory firm licensed by MAS. And he was previously the VP of major financial institution with wealth of financial experience and a CPA at Big Four, okay? And I mean, at the same time, he's also a member of the Chartered Accountant and also the professional estate planning practitioners. And consistently as the top 5% of the advisor worldwide with a lot of prestigious award, including being of one of the $1 Million Roundtable and of course the chairman of Roundtable CRT and a Producers Club every single year. So because right here as well, he actually specialized in the comprehensive personal finance, show planning, and of course the corporate planning as well for business owners, senior management, top executive and professionals for more than 800 clients, okay? It's pretty mouthful, and right now let's pan the screen to our guest right here for today, Mr. Raymond Wong.
Hi, good evening everybody. Nice to meet everybody on screen here. Sorry, I have to speak with my mask on for the obvious reason.
And I think we are pretty far away to meet.
Oh, yeah, absolutely.
Yeah, we should actually comply to all the rules and regulations. Yeah, in fact, the COVID situation is getting pretty serious. Hopefully, all our friends right at home do not grumble, stay positive, and of course, right here, let's learn something during this period of time while we are at home. Look at things on how you can build your wealth and retire early using unit trust. Okay, so with that, Raymond, I would like to understand. You were from things like Big Four, you were from so many prestigious places and stuff like that as well.
Right.
Why do you choose to be where you are today, and how did this whole thing happen?
Okay, good question. So you're right to say, Wendy, basically my former life was with the bank, about 10 over years with the bank. I started off with a Big Four accounting firm. So I'm still paying my CPA Chartered Accounting license. So basically, I enjoy dealing with numbers. But beyond that, I have strong interest to help people to grow their wealth. I'm very passionate in wealth planning and financial planning. So I asked myself whether I want to continue to work until late hours in the banks, continue crunching numbers. So I decided either now or never. So I decided to move on to join IPP. It's one of the biggest advisory firm doing then and then. So that here you go. I'm at IPP about 13 to 14 years coming.
13 years.
Over 13
you
years,
are
yes,
such
right.
a loyal person.
Thank you. So altogether about more than a quarter of century in my work career. Yeah.
Wow, that's indeed exciting. And let's take a look at the slides once again. I noticed that you have been featured on many places. Yeah, this is actually about the program that you are doing. I think that this is also a WhatsApp profile photo, right?
Yes. I love the photo. So.
Yeah, that's a nice one. And I also saw that you are talking about things like slow and steady to win the race for the investor itself.
Right.
I believe that you specialize in terms of investment portfolio, right?
Oh yeah, investment is definitely one of my forte. Apart from helping many to retire happy, retire early.
Yeah, retire happy and early. I think that's important. Retire early and doing nothing is terrible.
That's right.
So how do you define happiness?
Happiness. Okay, so good question. Basically, happiness can be in many forms. Of course, wealth is not the only thing that can give us happiness. But however, if without proper wealth planning, without sufficient income, the day we stop work, that will be a big issue, I would say. So I always advocate to all my clients, it's good to have two engines. One is active engine, which is active income. The other one is passive income. So both can be concurrently parallel running. However, one fine day, the active income will stop, because there's no way you're going to work to 70, 80 or 90. So not many people can do that. So at least your passive income is still growing. You have the choice to choose to work, or you want to continue to work at the retirement age, or even semi-retire. So that's how I define that.
Yeah, semi-retire, doing some volunteer job and all that, giving back to the society. I think that's something meaningful in our life, yeah? Especially now we know that life is actually pretty short at times. Yeah. And I saw that there's actually a lot of videos here. You were, where were you?
I have the privilege to share my 2 cents at Hello Singapore Money Week program and also a Frontline program. So I was invited to share what is CPF investment about, and how to maximize SRS, how to save your tax, and what are the things that you need to take note when doing financial planning, retirement planning, and so on. So always a pleasure to add value, and very passionate to educate the public.
And in many other events and all that as well, right?
That's
educating.
true.
I can tell that you're kind of like an educator. You know, a lot of people who are in the Big Four and all that, being a consultant by nature is always like our choice to kind of like share out to people and all that, right?
Yes, you got sharp eyes.
Because I'm a consultant myself, certified consultant also. We're always in the mission of like kind of like trying to educate people, sharing, helping, and all that as well. Okay, and the awards. I saw so many awards.
Thank you.
I'm pretty sure that you're currently a millionaire already, right? Okay, share with us your journey of being like MDRT or $1 Million Roundtable and the COT and all that, right?
Okay.
So how was the entire journey, and how do you actually manage to build yourself to that level?
So I felt I'm very blessed that in a way, even when I moved out from the bank to join IPP, one of the leading advisory firm, I'm able to help. Because in my mind, it's not just because of the money why I move on, because more important is my passion to help others, to help them achieve financial independence, grow their wealth. So that's something that I've actually picked up since young. So I felt I would like to impart this knowledge and share with many others, so that everybody, besides working hard, which is great, they can also rely on other secondary source of passive income. So that's why it brings me to move on to join the advisory firm.
Okay, so let's come straight to the proper of today's program itself. Okay, let's take a look at the slide. Next slide, please. And there's actually these typical consumer phases. Would you mind to share with us what kind of situation are we as a consumer nowadays?
Okay, so basically, consumers now they're actually spoiled with choices. Good and bad in the sense that many can do their own research. But in actual situation, it's a jungle out there in terms of financial products.
Yeah.
There's hundreds and thousands of financial products. So
Yeah.
I mean, even for us professional, we take a lot of time to learn and master it. Let alone, let's say, with due respect, anyone that working busy in their office wouldn't have this time to do all this research. So in our firm, we can just be a one-stop point. So all our clients do not have to shop all over the place. Number one, they save a lot of time. They don't have to go to company A, B, and C. Number two, after shopping all around, they can become more confused. So by coming to us under one stop, we do everything for them. So that saves them time and give them a peace of mind. Yeah.
Yeah, and it's the real advisory that we're talking about, right?
Exactly.
Because a lot of times people, when they see like, oh, insurance agent, they are kind of like scared kind of thing.
That's true.
Yeah. So how do you position yourself? Like over here, you mentioned things like advising instead of selling.
Yeah.
So what is the main differentiation of you that builds the trust for your clients to follow you for 13 years?
Okay, good question. Basically, like what you just mentioned earlier, I'm more like a consultant, educator, rather than a salesman. I don't look like a salesman.
You're definitely not.
So
you look like a prof, actually.
Oh, thanks so much for your kind words. so yeah, I mean, I truly believe along the way, I like to educate, impart my financial knowledge to all my friends and clients, so that not so much of selling them product they don't require, but rather give them informed decision. So that for me, very simple term, I'm like a financial doctor. So I wouldn't tell my consumer, hey, red pill is the best or green pill is the best, but rather customize according to their needs. So at the end of the day, they can achieve their goals more importantly. Yeah.
Understand.
Yes,
All
right.
right. So actually, right here, before we kickstart to the next slide, which is the unit trust, we actually have some friends right here. I just want to greet them. Dan Kenbing，大家晚上好，是的，晚上很好。那我们今天的这个节目是英文组哈。当然呢，我们改次有一些反馈，有些朋友说想要听中文的这个讲课，我看相信贵宾也是可以讲，对吧？以后
也可以，
也是可以，
不要太复杂的就可以。
对啊，而且你还上过那个早安你好。对吧 All right, 好的。Okay, so with that right now, we come to this part, which is what is unit trust, which is 信托基金, right?
Exactly.
So time to Raymond, would you mind to share with us, like, what is the difference between unit trust and ILP? A lot of people say that, ILP insurance, I don't want, okay? So would you mind to share what is the main difference while we invest into things like unit trust versus towards the ILP style of unit trust?
Okay, that's a very common question, Hui Jie. So, basically unit trust is just a pool of fund or investment that everyone get together. So unlike shares, certain shares is just to invest in one lot of shares, you need a huge amount of capital. Although there's penny stock, but generally speaking, you need a higher capital. Whereas for unit trust, you can just tap along together with all other investors to invest into a pool of funds. So with that, you can actually have more choices. You can invest into many kind of different industry. Even the good thing is you can even invest to globally, other part of the world that's not available in Singapore, even like US, China, and other countries. So on the note that what's the difference, the investment link? Okay, nowadays traditionally, you are right, to say that investment link basically in the past is like a hybrid of investment and insurance coverage, which means on top of the investment value, there's also some assured coverage. In the event, typically if the person falls sick, as in critically ill, or totally disabled, or worse still like COVID, if the person passed on, there'll be some coverage for that. But nowadays, the plans has actually evolved. So there are still those investment link using for coverage. However, there are also investment link that use more for investment. So these are more exclusive investment link, I would say. Very minimum insurance, to answer your question.
Yeah, okay. So that clears some of our doubts and all that.
Okay.
And in unit trust, right, sometimes when I just go online and search like Fund Supermarket and all that, I see like more than few thousand unit trusts. And it's like, well, stocks lah, bonds lah, money market REITs and all that.
Exactly.
Actually, what are all these things all about, and where do we actually start this journey?
Okay, so good question. Basically, for unit trust, you actually have the advantage to invest in all these different instruments, be it stocks, which is equity in the form of equities, bonds, which is another name for that is fixed income. Money market is basically slow and steady, kind of like a savings. And REITs are, as the name goes, typically they invest into property funds.
Understand.
So
Yeah.
for unit trust, you can choose any of these different kind of nature of assets, or you can just focus on one or two that you like most.
And I think today you're going to teach us how to read the fund sheet, right? And the fact sheet, right?
Sure, we can run through that very
All
quickly.
right, great. Because a lot of the times, right, we always just depend on our financial advisor.
Right,
And for some
right,
people who
right.
actually buy themselves, they will just look at, okay, the chart seems to be going up. It's a good fund.
Sure.
But a lot of the times, we kind of neglected some of the essence in it. And today we're very lucky because Raymond is going to be here to share with us on how to read the fund fact sheet itself. Okay, let's move on to the next thing. We keep talking about dollar cost averaging. So dollar cost averaging in unit trust, how does that work then? We
Okay.
always hear about stocks, dollar cost averaging,
Yes.
Invest for the long term. How about unit trust? Is it the same method as well?
Yeah, it's pretty similar. In fact, the whole concept of dollar cost averaging. So dollar cost averaging, some people they call it regular saving plans or dollar cost averaging, which simply means it's a form of strategy that every month consistently the investor put in X dollar amount. So it can be like what you mentioned, stock. It can be applying to unit trust. Even can apply for 101 investment linked product, for instance. So it's nothing sexy per se, just a disciplined monthly investment that the person invests in. Can be monthly, quarterly, and so on. So there's obviously why is this a good strategy? It sounds quite simple, and why is it so great about this strategy? In simple terms, okay, as you can see, let's say assuming the person put in every quarter $1,000 for the next 1 year, so he have invested about 4,000 the total outlay. Okay, by doing so, even when the price go up is great, of course. But if the price go down, he's not so fearful because it's a bit like Great Singapore Sales. You buy it cheaper. Instead of normally you can buy 50 units, you can buy 80 units.
Yeah.
So it all adds up. So end of the day, the person will, hey, sometimes I'm buying cheaper, sometimes I buy higher, but overall it's still a gain. So he's not so worried even when the price drop by doing this very disciplined way to invest. So end of the day, as this example has shown, the person can gain 1,500 out of 4,000 just by doing this strategy. Yeah.
Yeah, that's indeed good. And how about lump sum then? Some people are like, oh, I'm very cash rich, I want to go in. How do we time it, or how does that work?
Correct. So yeah, you raised a very good question. So lump sum is also another good strategy. Some people, they have a lot of lazy money, so to speak, in the bank. They do not want to let it rot. I mean, interest rates all-time low. If we don't do anything, it will be so-called eroded by what they call inflation monster, because money will keep on going down smaller and smaller. Okay, so by doing a lump sum investment means they have some lazy money. They don't mind putting invest a lump sum one time, so it can grow. So technically, if you put into something good investment like blue chip stocks or go into a good quality funds, it will grow over time. But of course, lump sum during short term there may be some volatility. So I would say it's good to apply two strategies given a choice. So like this example, Mr. A is using two strategies concurrently. He has a lump sum, 100K sitting in the bank doing nothing. On the other hand, he has this very powerful tool called cash flow. So every month he can save, let's say, $1,000 or more. So he decided to put lump sum 100K today plus 1,000 every month disciplinedly. So using this strategy, it definitely works, even enhance the whole purpose, the whole objective of growing the wealth. So let's say if the investment does grow to 4% or even 8%, the money will multiply. The longer it is, the better it is. So it can be a combination of both if the client prefer that way. Having said that, of course, due to limitation, if he has less cash flow, he can just go for dollar cost averaging, which doesn't require a huge amount. Yeah.
Okay, sure. So with that, right, actually the longer you hold, the lower the risk. I think it's actually also the same thing, the dollar cost averaging, right?
Yes, okay. This one is simple. It applies throughout. What it means, let's say if the person have very short investment horizon, let's say you only got 6 months, I would advise the person just put in a fixed deposit because within 6 months, 1 year, it can be very volatile. Good time, yes. Just like last year, COVID, no one imagined the whole stock market price can go up.
Yeah.
Not good for economy, but fabulous for the investment due
Yes.
to very sentimental reason.
Yes.
A lot of reason behind that. So, so for that, if only 1 year possible, it can grow fast, but it is the double-edged sword. It can go down as well.
Yeah.
But as the time goes by, let's say you don't mind, okay, I just stay invested for next 5 years, 10 years. The risk of losing it will go down. Example, 5 years become 10%. 10 years become 4%.
Okay,
Yeah.
so we're still on this slide. Are we done with this?
Yes, that's
okay.
that. Yeah, that's right.
All right. I love seeing this kind of
But,
charts because it's like growing up.
Oh, yeah.
Okay, so mind to share with us more about this performance chart itself?
Okay, so basically investment.
Okay, so we're still on this slide.
never
Are we done with
if somebody tell you it's a rocket straight line, don't believe him or her. Because throughout investment, yes, they are fearful of investing because they fear they will lose money. What if I invest today, I lose 50% or 80%? What happened then? So it's a bit like a very simple analogy. If I like to eat a plate of chicken rice, it's across the road. But I dare not cross the road, so I miss out the whole plate of chicken rice that I wanted to consume. So that is an opportunity cost by not doing nothing because inflation, as I shared, that's another risk.
Yeah.
So by doing so, if you have longer term investment, as you can see, but quality investment, put into something that really quality. Don't put into something too lousy stocks and something that you are very unknown in that sense. So with that, even during the last 2 decades, you have a lot of crises. You have, you name it, you have it like Asian crisis, you have a subprime crisis, 2008, then you have SARS and so on. All these crises, wow. Then what happened? Most people will be very fearful. But if you look at the chart, actually, it's still on a growing trend. Despite short term, there could be some hiccup, but overall, it's still an uptrend. Compared to the flat line right below by putting in the bank, it definitely you gain nothing much.
Yeah, I'm pretty sure.
I mean, having said that, it's definitely good to keep 6 months to 3 months of rainy day money, just in case you need to withdraw.
Yeah. And how about this? We have a next chart here that is also showing an upward trend. Okay, it's not moving. Hang on a second. Sometimes it's a bit slow.
No worries.
Okay, we come to this one, the asset allocation guide.
Yeah.
So, mind to share, like, I think that this is actually 4 different type of profile of the investors, right?
Exactly.
Would you mind to share with us, like, how do I know if I'm conservative, moderate, aggressive, or very aggressive? How does that work?
Okay, good question. When it basically, okay, I mean, in the actual term, when we meet our client or investors, we'll let them we'll understand a bit more from the risk appetite or do some risk profiling. Have just ask simple question, have they ever invested? And what if the investment drop 10%, 20%? Can they stomach the investment drop? Or if they drop 10 cents, they cannot sleep at night. So probably this is not for them. So in that sense, for short-term volatility. So in that sense, if the person is a bit more moderate or conservative, there will be basically 2 parts for the way I look at it for investment allocation. So one I would define as equities. Equity is like stock and shares. They are the growth fund, basically that can go up faster, but it can come down faster during downtime as well.
Yeah.
Bond is typically more stable, which is termed as fixed income.
Yeah.
So it's slow and steady, but at least can beat inflation. So if the person is more conservative, I will allocate more towards the fixed income, lesser to the equity. If the person more aggressive, it could be 60 equity, 40% bond. So that's that kind of manner to allocate. Yeah.
And how about this thing called the rebalancing portfolio? If I remember correctly, I used to buy one ILP close to 10 years ago
Right.
with Prudential, and the agent actually told me that I have to do a rebalancing every single year. So is that what is the same meaning for rebalancing the portfolio?
Okay, so basically rebalancing in simple terms is mean just to switch the existing fund. Of course, not switch for the sake of switching. Okay, so switching can be 2 reasons. Okay, it's always good to regular switch. Let's say the person have fund A, B, C, D, E, and the person, let's say, is moderate appetite. So it could be like 60 bond, 40% equity. However, as the stock pick up, investment market grow, the portfolio that he or she is holding, it could become like somehow become 70% equity or 30% bond. So in that sense, this sort of deviate from the risk appetite. So it will be good to actually reallocate and switch back to close to what the risk appetite of the investor. So it could be back to 60-40, 60 bond, 40 equity. So the other scenario is, let's say when the market goes head south for some reason, some bad news going on, we will see is this a short-term correction or is it a very bad situation that can last for a couple of months or longer. So it's good to switch to be a bit more defensive, more bond and less equity during such period. Yeah.
Like, to be frank, right, I know that the benefit of going for rebalancing is always to get a higher return and a lower risk. But I kind of recall my agent don't really call me. So what should we as an investor or like policy holder actually do? Should we like monitor? Nowadays it's better. You know, in the past, I remember I first bought it like close to 10 years ago.
Wow.
It's only statement. Every month I get like statements over statements and all that.
Okay.
But nowadays with the app and all that, how frequent do you recommend us to log in to check?
Okay, so I mean, okay, if you're a regular investor, I mean, there's no point checking every day because the differential won't be a lot.
Yeah.
So, if you ask me for rebalancing, it's always good to review. Okay, firstly, it could be due to any big event trigger. Then we can ask ourselves or check with our advisor: is this short-term hiccup or is it a long-term correction? So do we need to switch the whole portfolio? If not, nowadays, even I have the privilege to working with my firm, whereby we have an auto rebalancing system. If they choose to select this auto rebalancing system, means every quarter the system will auto trigger to rebalance for our investor. So all the investor will do is click the button, then the whole thing will trigger to rebalance every quarterly.
I see.
So we actively rebalancing compared to someone that do nothing, buy and hold. I mean, unless you are Warren Buffett. Otherwise, most of us, we would like to rebalance regularly to see is it still performing after 6 months or longer, let's say.
Understand.
That's
So
right.
there's actually this sample portfolio investment. Would you mind to share with us, is this something that the system can generate or how does that work? Or do we select our own portfolio based on our category of the risk appetite?
Sure. I mean, of course, it's always good to consult, let's say, the advisor, so that you know exactly what funds or what sort of investment you're going into. So for this model, I'm just giving a sample. Again, this is from our in-house portfolio. So in that sense, let's say I choose moderate appetite. So moderate, as we went through just now, right, it's like 60 bond, 40 equity. So the fund that being selected will be maybe 3 funds is rating to bonds, maybe 2 funds is rating to equity. So in that sense, we have that good balanced portfolio. So so again, if we can go through those auto rebalancing system, that again my in-house firm, they have this privilege, they can auto switch for you. Otherwise, let's say on their own accord, the client can actually look at the fund, maybe sit down with the advisor to rebalance every half year or so on, if there's a need to. Yeah.
Okay.
Right.
So I saw some things like the sample of top performing funds.
Yeah.
How do we as a layman even know if this is top performing? So do you benchmark based on the returns or the dividend payout, or how does that work?
Okay, for this scenario, that's a very good question. For this case, we just pick up very simply based on the top performing for the last 1 year, last 3 years, or last 5 years. So some of the top tier funds for the last, as you can see, last 1 year, wow, it's a whooping double digit or more than double digit.
Yes.
So of course, this return may not be guaranteed every year. However, if you go into quality fund, chances are the upside is definitely higher, despite the short-term volatility over mid to long term. So basically, these funds are selected based on the top tier funds. Either can do it from the system or from our in-house system. Yeah.
Okay. Yeah. So now we come to the actual thing that we want to learn today: how to read a fund fact sheet.
Right.
Okay. Yeah. Raymond, to you.
Okay. So very simply. Okay, I just pick 3 funds based on, because 3 different type of funds. One I would say is equity funds. The other one will be high yield bond, so more towards bond. And third one will be like a balanced fund, so a bit of bond equity. So for this instance, it's an equity fund. Example, Fund Smith is one of the top tier funds, I would say. But having said that, not all platforms have this fund. So certain platform, of course, being advisor, we know which platform has this fund. We can invest in part of these funds. So example, let's say for this spreadsheet, for this fund sheet, you can look, firstly, the return itself at the middle of the page is quite straightforward. You can look at the past 1 year, 3 year, or year to date up to the first 4 months or 5 months. However, don't just look at the performance itself. I mean, for the last 4 or 5 years, last 1 to 2 years, you should be look at a bit longer term. Okay, so apart from the performance, of course, if you see everything is red, obviously you wouldn't think this fund is good. So if some funds are positively over the last 3 years, 1 year, or 5 years, then there's a potential there. Apart from that, let's look at what's the nature of the fund they are holding. Example, they can invest into different sectors. So now the top of the town is like Elon Musk, the tech fund and so on. And also healthcare. Healthcare is booming for the obvious reason during this time, COVID. Everybody want to enhance their medical needs, their supplement. Apart from that, consumer things still goes on. Even downtime, people still need to consume different staple food and so on. So from the sector, you can see roughly what the industry they invested in. Secondly, for this fund, just for example, it's also investing into US and also some of the stronger European countries, Germany, UK, and so on. So just take note, as long as they have some exotic country like Ukrainian or so on. So maybe the big country that doing well, that should be quite a good yardstick. And not only that, also they are holding company like like what we just went through. Correct. Okay, this I believe this will interest you. So
because it's growing up.
Yes, upward.
For layman, it's always like, okay, it's growing up means it's a good fund.
Correct. That's just what Warren Buffett was saying. When everybody fearful, he become greedy. So not to worry in that sense. Investment there'll be up and down, but long run is fine as long as it's a good one.
Yes. Okay, sure. So I have another one here. Actually, this is Alliance Income and Growth. Actually, I have this one as well.
Wow.
It's paying 6 to 8%. Yes. So how do we define this kind of thing if you are a layman? How do we know that this is actually a high yield income bond that's giving high dividend every month?
Okay, good. So very good. I think this one is a pretty good fund. I would say appetite will be moderate and above, so to speak. Okay, it does have bonds like high yield bonds, convertible bond, and also 1/3 of equity. So but I would say majority are into high yield bonds. Okay, and in which this fund a lot of my clients, even myself, I like this fund because it pay good dividend. I share. So some of my clients who are retiree, they enjoy maybe 8% per year. Not too bad. Just put a lump sum every month. They just collect few hundred to 1,000 a month. So not too bad as an extra income, as a passive income.
So does that mean that actually going into income and bond will get us a high dividend based on this sample case scenario? Does that mean that way in financial terms?
So high yield bond typically they are like BBB. The risk appetite is a bit higher, so that's why the payout, as the name goes, can give you higher yield. So in that sense, so typically for this type of high yield bond, they will have dividends coupled with capital growth. So both of them add together, that should be giving you the pretty positive upside over mid to long term.
So do we also need to check on, like, there's a lot of words here. Do we also go and check on every single particular item before we decide to buy it?
So this one, you just need to focus on the currency that you are investing, because some are in Sing dollar, some are in US dollar, some is in other currency, but or renminbi. But most people would, in local context, will be investing in Sing dollar. So just zoom into the Sing dollar column. So from there you can look. They'll tell you how much dividend yield you'll be getting, what is the past performance, and also the what is the ratio for the financial ratio and so on.
Understand. All right. Okay, good. That's indeed a good one. And I saw one of my favorite as well. I think they just
very
changed.
Good choices.
They just changed name, right? It used to be First State Dividend or First State something,
now they call First Frontier Bridge.
First State Bridge. Yes. So from what I recall, they are Australian fund house.
Right.
And what happened? Why is there a change of name? I mean, a lot of the time people say, change name means like maybe there's some mergers, there's some restructuring and all that. Like what happened to like CapitaLand kind of stuff?
That's right.
So is there a reason for the change of name, or is it because new fund coming out, or how does that work? Okay,
basically it's just the fund house. They have some changes in the restructuring. So in terms of their component, the funds that they're investing in, so pretty much the same. So not much change as I share with all my clients as well. So not to worry, despite changing name, it's not a drastically change in terms of their investment strategy. So it's very minimum change, I would say. Some could be a bit more eco-friendly, like currently the talk of the town to be a bit more
ESG,
greener. Yes,
the ESG topic that everyone's talking about.
So that could be some element in that. That's why they are focusing on that as well.
I see. Cool. So is this kind of fund different from the rest that you shared just now, or?
Yes. So basically, good question. This one will have why I call it balanced fund, because it's half bond and half equity, almost equal. So you saw like best of both worlds. But I would say again, it's moderate and above. So some they like to have a big bonds. They don't want entirely is equity. So they will like this one. This one of my favorite fund, just like you, because I felt it's an evergreen. I mean, despite short term a bit of volatility due to correction, but long term is still pretty positive. Not only that, they also give a dividend about, I think, close to 4% per year. So which is quite decent, I would say. Better than bank, much way better.
0.6% now.
Oh,
With fixed D.
Correct. Even, if fixed D you're talking about normal bank savings can be 0.05, close to nothing.
yes, correct. I think it's better to put in CPF instead.
Yes. Good to diversify.
All right, okay, so there's actually this article here, don't let inflation take you by surprise.
Exactly,
So does that mean that our money is like getting lesser and lesser? I think there's this slide below here that I really like. What is my dollar worth now and in the future? Okay, would you mind to share with us?
True. I mean, in simple terms, this one, today let's say $1. If the inflation, I would say last 30 years is probably 2% to 3%, depending what goods they are talking about. Of course, the most expensive two big ticket items will be the house, will be the car. Inflation rate even much higher. But let's say on consumer goods itself is about 2 to 3%. Assuming, let's say I take the middle range of 3%, if today I got $1, 20 years later when I retire, example, it will be $1 will be worth how much? 55 cents. So it's almost a dip of 45%. So it is like why very simply nowadays you will go to normal coffee shop, don't talk about Akun, Starbucks, or the Atas cafe. Normal coffee shop, a cup of coffee maybe 130. 10 years ago, I believe it's about maybe 70 cents. So I can imagine 10 years later, same cup of coffee, it could be $2 to $3. So the value keep depreciating. Even if we don't do anything, the risk is still there.
Yes. So that is why we need to kind of like see and select the proper instrument for different objectives, right?
Exactly. I like this slide a lot because, if you follow, the guy thing, we like to watch soccer, football. so pretty much a very similar analogy in the sense that, some of our savings, our funds, we should put it as like a defender or goalkeeper to defend our money. So these are very safe and sound. But it's like fixed deposit, like what you mentioned, normal savings account. Good to have 3 to 6 months of our living expenses as an emergency fund. But beyond that, it doesn't make sense to put everything in the bank, because even if we don't do anything, money will get eroded by inflation. So some they may put into some savings plan, some retirement plan, some bond fund, or some portfolio investment. If they're a bit more savvy, they can put a bit more aggressive type of investment, be it business or property is a big ticket item, of course. So it's good to have three different kind of allocation.
I heard they are getting higher and higher for interest rate recently for property. Is that true?
Interest rate slightly climb back, but it's still all-time low per se. So it's interest rate is good for the financing, but not too good for the deposit in that sense.
That's why we need to put our money into capital market instead for now.
Oh yes. I mean, good to have something that can grow higher than interest rate itself.
Understand.
Yeah.
All right. Okay. So here today we're going to learn about one more item here, which is called the 72 rule. So what is this rule 72?
Okay. So you see the old man up there. May I guess who is this strange-looking old man?
Einstein, right?
Very good. Yeah. So
I think my knowledge is still quite good. I'm still carrying that.
Some call it genius, some call it insane. But anyway, he come up with
he's pretty insanely genius.
It's a very fine line between the genius and someone. So this I like this formula. It's very simple, but it's very powerful. It simply means, let's say, if I got a sum of money, assuming 10,000. if I want to grow to 20,000, double up the money, how long will it take? Okay, let's say if you go down further, let's say 72, simply divide by very simple rate of return. It will be a number of years that you require. Okay, assuming 2%, definitely not fixed deposit, have to come by. It's all below 1% or 1. So let's say 2%, some instrument that give you 2%. It will take you just 72 divided by 2. It will give you about 36 years to double up the income. Okay, if let's say if you put into fixed deposit, even lesser than 1%, you take about 72 years, just simply 72 divided by 1. But not all of us is like a centurion like Einstein, so we may not live 100 years. So may not wait that long to enjoy this fruit of the labor. So definitely good to put to something that work our money harder.
At least 2%, right?
At least, I would say at least, okay, beside curb inflation, 3%, I would say.
3%. Okay, so the first state is still good. First
it's first state is much more than 3% over mid to long term. I would say 5, 6, 7.
5, 6, yeah. Okay, good. Correct. So we heard about one very famous person. Now there's another famous person here. You got blocked off. I think it's me. That's me.
Okay,
because the screen kind of got blocked off, right? Anyway, Warren Buffett. Yes, Warren Buffett had this secret recipe. He says that the market is irrational. Take advantage of it. So what should we do?
So again, I think this one of the richest man in the world. Obviously, he's an investment guru.
Thanks for the production crew. He just shifted us away.
Okay.
So now we didn't block Warren Buffett. If not, the Warren Buffett Coco will be very angry with us.
Okay, very good. Good thinking. Yeah. So he mentioned a very good point when we talk about investment, don't be too emotional. So your market drop 10 cents or so on overnight, just do not be too fearful. In fact, when the price drop, it's a good time to invest because, example, if I got, let's say, a lump sum of money, when price drop, I'll invest. Let's say today, assuming I got maybe 50K, probably if I worry about the market up and down, I put 25K first. When the price drop, I become like Warren Buffett, like what I say, I become more greedy. I'll put another 25K. So in that sense, to me, it's like I give myself a great Singapore sales and buying cheaper. So that will actually enhance my investment return. Yeah. So in just not to be fearful when everybody become greedy as well. Yeah.
Yeah.
That's right.
Okay. All right. Let's take a look at the next one here. You have achieved financial independence when you choose not to work tomorrow and still can enjoy. How does that work?
Yes, so the definition of financial independence is very interesting. So to me, financial independence means, okay, at least I have the option. I can, let's say, 5 years, 10 years down the road, I can choose to work because I want to work, not because I have to work. I have to work just to survive in that sense. So having that choice, having that empowerment is definitely a very good sense of satisfaction, I must say. So basically, when we talk about retirement, achieve financial freedom, independence, it doesn't mean you have to stop work totally. It could be you may want to choose to do something that you enjoy, something more relaxing, or by then you can take your time to go for holiday, not now, but maybe after the COVID. So when whole thing back to normal, so-called, or at least when we can travel, you can enjoy much more and you not have to worry of your future expenses. Where's the money coming in to take care of this expense? Yeah, that's the beauty of financial planning. Yeah.
All right. So that is indeed a pretty great one. I hope that the unit trust. Do you think that unit trust alone can help us achieve financial independence?
Okay. Very good question. So it depends. Okay, let's say younger folks like yourself, I mean, most of you, I believe, most of them, let's say younger investor or client, they are more inclined to investment. Having said that, okay, because why? Because they have a longer period of time, even before they reach retirement, easily 20 years, 25 years. So they can have time to compound the investment return and they can stomach more risk, so to speak, using the dollar cost averaging that we went through. On the other hand, let's say a bit slightly older, could be 40, 50, they can, as our age goes by, the risk appetite may drop also. So they could be put into something lower risk or savings plan or retirement income plan. So if you ask me, good to have both. One that give you a potentially higher return through the mode of investment. The other one that give me guaranteed income. So whether my market up and down doesn't matter. I know by this age I'll get X dollar per month, rain or shine. So best of both worlds, I will have that. That's I always share what I believe in, so I'm doing that myself too.
Yeah, and I think the next slide really kind of struck me. The
Sure.
company name that you represent, Investment Protection Planning, IPP.
Yes.
Yeah, share with us more about how this entire philosophy started and where were you all in the
Okay.
past and currently.
Sure. In IPP Hokkien, they mistaken as IPP.
IPP.
So it's not. Okay, joke aside, actually it
IPP.
means investment protection planning. So it actually encompasses the whole thing by itself, even by these three letter words. So because we are one of the oldest financial advisory firm, so we are one of the pioneer being since 1983 because in the market, you meet three type of advisors, no matter how they call it, what they call themselves. Okay, firstly, you'll be like insurance agent, could be like Prudential that you mentioned, example, or AIA and TUC. Secondly, you'll be a bankers like relationship manager from DBS, Citibank, and so on. So thirdly, you'll be a financial advisor or independent financial advisor like us. So basically, the difference between us and the first two, we can market or advise any of the product A to Z. So we need not tie into any particular company. So most people like this idea is like you want to get laptop rather than going to Toshiba or to Acer. You can walk into IT Fair. You're spoiled with choices.
Yeah,
so
everything
if
is
Acer,
there.
doesn't matter, buy Apple
Yeah,
and so on.
that's why you have like so many partners.
Exactly. So
Yeah,
we have
that's servicing you.
90% of the insurers are our partner as well. So,
Wow,
yeah,
that's
so it's always
a
good to
lot.
analyze across the board because one company may not be best in everything. Yeah.
And so many fund houses.
Oh yeah, absolutely. We are close to 1,000 funds. So to begin
Yeah,
with,
more than 1,000
so
funds.
whichever good our client can invest, doesn't matter. Yeah.
And how do you partner with banks at this part?
Oh yes, so in terms of banks, of course, mortgages is property is one of the biggest commitment to many. So when we talk about financial independence, let's say when you retire means a fully paid house plus a stream of income. So mortgage is definitely very important. If you can save money, because as we discussed, interest rate is all time low now. So you can find whichever package that gives a lower interest rate. You'll be surprised, let's say if the loan amount outstanding is huge, you can save hundreds to thousands a year. That's good money to go on holiday or whatever you want.
Yeah.
So that's how we partnered with the banks as well in terms of mortgage.
What do you do with private banking institution? Is it for like high net worth investors or borrowing, or what do you do with it?
Basically, it's a bit like private banking, so to speak, but not exactly private banking. So we do have some plans that we can work with banks to give what we call premium financing for our clients. So some affluent, high net worth or more affluent clients, they don't mind. Okay, they have 1 million sitting in the bank, but still they don't mind using the power of leverage to use the small interest rate to gain much more. So with that, we work with bank to finance the plan, be it like retirement plan or be it like a protection plan. The popular one was called Universal Life, or for retirement now also like hotcakes is like an annuity plan. So example, let's say 1 million plan, they just put in 300k, 30%. So 70% will be funded by the bank. So the 700k they can use to do something else, invest and grow their money. Yeah.
Understand. Cool. And so how can you help? I mean, company aside, pretty sure you want us to like retire happily,
Right.
investment strategies that you can do, secure the protection, and even like estate planning. Actually, I'm quite interested in the area of estate planning.
Sure.
So does that mean property, or does that mean wealth distribution, or how does that work?
Okay, so a lot of people they mistake the estate plan. Oh, is it talking estate, real estate? So it's not entirely relating to real estate per se. Estate planning basically means to preserve, because we work so hard. We want one fine day we definitely may not be on this earth anymore. It can be 10 years, it can be 20 years or 100 years down the road. But only two things is certain in life, which they mention is death or taxes. So if one fine day we are not around, we definitely do not want our hard-earned money to go to the wrong place. So we have proper estate planning, like writing a will. You can allocate the assets to your favorite charity, favorite church or temple and so on, or to your loved ones, so that you go to the right place. And also not only that, you can allocate the fund to them at certain age, because by doing proper planning, if let's say a family that have young kids or even at age of 20, if they inherit, let's say few million, 1 million and so on, what's the natural thing to do? They may buy a sports car and that's it. So with proper will planning, that will be mitigated the risk of using all the money. So it can last 3 generations. Or even LPA means with lasting power eternity, means the person still alive but mentally incapacitated. So at least they can assign somebody the donee to take care of their assets. Yeah. For trust, some of them they want to set up trust to manage their assets. So all these fall under estate planning. Yeah.
So are you certified to do estate planning?
Oh yes, thanks for asking. Yeah, I'm currently working with Precept. Formerly it's called Rockville, also one of the biggest trustee company. Yeah, so I'm partnering with them. So I'm a certified professional estate planner, so to speak.
So are they mainly local clientele or overseas clients who, like now Singapore is having a lot of global investment program, as long as any foreigners invest 2.5 million in Singapore, you can get yourself a PR, you can come up with certain VCC funds and all that. So is that mainly targeted for foreigners only? Because it sounds a little bit rare for the locals to learn about, I can build a trust kind of stuff.
Oh, okay. So local can also set up a trust. Overseas investor or foreigner can obviously also set up a trust. I mean, depending what's the objective for.
Yes.
So some they may want to set up a trust, like a family trust, so that this lump sum of money, okay, will go to their loved ones, and so they will not touch this money, so that whatever dividend payout or whatever cash will pay out to let's say the person that they put in the trust. So in that sense, after 5 years, some they can draw the line between their personal assets and their business assets, so that their creditor may not even go after 5 years if they put into a proper irrevocable trust, what I call. Yeah.
Yeah, Raymond, since you do will, right? Just want to ask you one question.
Sure.
A lot of people say that writing a will, I can write myself. Or even if I get a lawyer or someone that is a professional to write me a will, sometimes it can be tall as well.
Sure.
It doesn't make sense to even craft a will. So what is your opinion and thought in will writing?
Okay.
Yeah.
So I've often being asked this question as well, Vijay. So basically, have a will. Okay, no longer it doesn't mean the person must be high net worth, the rich and famous to have a will. Anybody should have a will, if you ask me. Reason being, you, as far I pointed, you do not want this asset to go to the wrong place and to the loved one. So why you want to engage a professional to write a will? Okay, it's definitely safer in that sense, because if we just use a simple template, because you just save few $100 for instance, but there's a lot of loophole in the will. End of the day, this will can be voided.
But are wills like certified, or maybe like property, right? There's a rental tenancy, you can go and do stamping with IRAS.
Right.
But what about here? Are wills like governance by anything or?
Okay. Yeah, good question. I mean, for will, we can register with a will registry in that sense, but the will itself, you still have to either carve out yourself if you have the know-how and you know all the blind spot. Otherwise, I would suggest good to go through professionals, so that in case anything, for example, let's say a couple go to accident, just a question, if husband and wife travel to New Zealand, hit an accident, who do you think the assets will follow? The husband or the wife? Make a guess.
I think should be the wife. Woman charter, right?
Right. Yeah.
Is that true?
Okay.
Did I guess it correctly?
Okay. That's a good guess. Okay. Provided the wife, I mean, typically wife is a bit younger than the husband, so the younger one the older one will deem to pass first. But sometimes the husband could be a few months older than the wife, so the wife could be a few months older than the husband. So because it passed to the husband, so it can be vice versa. So the older one die first, then the younger one will receive. But there's no point doing so, because the younger one also no longer on earth.
Yeah. So does that mean that the wiser move is to choose an older husband, and for the guys is to choose an older girlfriend or wife?
So that's a very good thinking, good try as well. But I felt with the will, all this can be mitigated. What they call a common disaster clause.
Yeah.
So let's say the spouse doesn't survive more than 1 month, the will will still follow the deceased. So in that sense, there's no argument. Yeah. Right.
Okay, cool. All right, that's indeed a very nice sharing and all that. Raymond, I saw that you have like so many testimonials from your clientele.
Thank you so much.
Wow, and this is really just like too much. We have like 2 slides of it. And of course, I believe that you are definitely offering some help to our audience here. For those who have any questions and all that, feel free to Zoom over to Raymond now, although that we can
COVID, especially,
we we can meet, but best to just stay home, feel safe, and all that.
At the
Zoom
comfort
with
of the
us. Any calls? No calls?
Yeah. Can call me as well. Can contact me. Drop me an email. Then my team will try to reach back to the person.
Certainly.
Arrange a mutually convenient time. Yeah.
Certainly. All
And
right.
that's my website as well. If they can browse through or leave a message at their own ease, that's fine as well. Yeah.
Sure. All right. So we come to almost the end for today. So if you do have any question pertaining to money mastery, feel free to contact the guest directly, or you can always write in to us if you have any interest or topic that you would like to learn. I have friends who are saying that I want to learn about things like REITs. I want to learn about things like how I can analyze stocks, how I can look into S&Ps and stuff like that. Anything that you have desire to learn, just drop us a mail and we will definitely try to cater to your needs. Okay? So with that, we come to the last two slides, and beforehand, before we end off, a disclaimer once again, this program is only for information only, and please do consider your risk tolerance before you make any decision. And of course, we strongly urge everyone to consult a MES certified professional before you actually make your move. Okay? So with that, we come to the last slide for today. Before we end off, Raymond, anything to share with all our audience right here? In your opinion, what is money mastery to a person's finance growth?
Right. Okay. Yeah. Okay. Let me rephrase your question. Okay. What is money mastery to everybody?
Yes, to individuals, to fellow Singaporeans.
Right.
Yeah.
Yeah. So I would say I like this quote. Actually, it's not money is not the root of evil. It's the love of money is the root of evil. So having said that, without money, it's pretty hard to survive and go through. So in that sense, always manage our money wisely. So if we can manage our money well by doing planning, it's always good to do planning early than later. But even having said that, it's also better to do your planning now than never, so to speak. So always good to review your finances, make sure your cash flow is positive, and not only that, how can you maximize your dollar and cents? And last but not least, also to protect the person's income, because we ourselves is the greatest asset, not our house, not our car. Anything happen to us, we will lose the income for the next 10 years. So also there a good income protection, so to speak, and medical protection. Yeah.
All right. Yeah, that is indeed a good one. We come back to the IPP,
Yes.
investment, protection, and
Planning.
planning.
So sum it all nicely.
IPP. I remember that. Okay,
good,
so that
very
is
good.
actually a very nice one. And thank you so much, Raymond, once
Thanks
again
for inviting me.
joining us right
Okay.
here at the studio itself. It's indeed a very, very nice journey on. We have learned things like how to look at unit trust, how to build a portfolio, and we look at 3 different types of unit trust. That is the growth type, and the second one is the aggressive one, and also the moderate one for people who wanted something more passive. Okay, so with that, thank you so much, everyone. And of course, once again, thank you, Raymond.
Thank you
And
as
of
well.
course,
Thank
we hope to bring you more valuable content. Do stay tuned right here for the next series of Money Mastery Show. I'm Hui Jie, and together with Raymond, we are signing off for today.
Stay safe.